the battle for a unified reserve. It began with a simple realization whispered among policymakers and financiers alike. The nation's financial system, powerful as it seemed, was unable to protect itself from its own internal storms. Each crisis hit harder than the last. Each panic spread faster. And beneath every collapse lay the same unspoken truth. The country lacked a central force strong enough to steady the system when fear overtook reason. To understand how this battle took shape, we must return to an America exhausted by recurring financial shocks. Banks operated with uneven reserves. Regions competed instead of cooperating. Seasonal strains could freeze credit across entire states. And every few decades, a panic reminded the nation just how vulnerable it remained. The economy had grown modern, interconnected, ambitious, but its safeguards belonged to an earlier age. Frustration grew among those who studied the patterns. They saw the same weaknesses repeating in different forms. Shortages of liquidity during harvest seasons, sudden spikes in interest rates during periods of speculation, and catastrophic withdrawal lines whenever confidence dipped. Newspapers called for stability. Merchants pleaded for predictability. Even some bankers admitted quietly that the current system no longer matched the complexity of the world unfolding around them. Amid this growing tension, a new idea took hold. The notion that the nation needed a unified reserve, a central mechanism capable of supplying liquidity, coordinating policy, and preventing spirals of panic. It was a concept both logical and controversial. Some saw it as the missing foundation of a modern economy. Others viewed it as a threat to local authority and financial independence. The earliest conversations were tentative, meetings held in discreet offices, letters exchanged in careful language, proposals drafted, revised, and set aside, but the idea refused to fade. Each new disturbance in the markets added weight to the argument. Each minor shock hinted at a deeper instability, and each unanswered question revealed a stark reality. Without a central force to anchor the system, the next major panic could tear through the country with unprecedented force. These opening beats marked the beginning of a battle that would test ideology, power, and the nation's willingness to evolve. The push for a unified reserve was no longer a theoretical goal. It was becoming a necessity, one that would soon ignite a struggle capable of reshaping American finance forever. Momentum for a unified reserve grew as the nation's financial fractures became harder to ignore. Each new disruption, however small, reinforced the sense that the system was running on borrowed time. Business leaders complained of credit tightening without warning. Farmers struggled with seasonal shortages that left them vulnerable to forces beyond their control. Even regional banks, once proud of their independence, admitted privately that they lacked the tools to withstand sudden shocks. The pressure for reform no longer came from a single corner of the economy. It radiated from every sector touched by instability. Early proposals attempted to strike a delicate balance. Some suggested a cooperative network of banks pooling reserves for emergencies. Others envisioned a central authority with the power to issue notes and guide market conditions. These plans reflected an uncomfortable truth. The nation had outgrown its patchwork system, yet agreeing on a replacement proved far more difficult. Every solution favored some interests while threatening others. Every compromise raised new questions about power and oversight. Debates intensified in political chambers where ideology and experience collided. Reformers argued that a unified reserve will provide the stability needed for a maturing economy, an anchor in moments when fear spread faster than facts. Opponents countered that centralization risked concentrating power in the hands of distant elites, undermining the independence that local banks had long defended. The arguments grew sharper as evidence mounted that the existing structure was not only outdated but actively dangerous during times of stress. Meanwhile, financiers and economists drafted increasingly detailed proposals, hoping to bridge the divide. They pointed to models abroad, where coordinated monetary systems had softened the blow of economic swings. But critics dismissed these examples as incompatible with American values, insisting that the nation must chart its own course. The result was a stalemate in which everyone agreed the system needed change, yet no one could agree on how far that change should reach. Outside the halls of power, the public followed the debate with growing anxiety. Newspapers published stories of near failures. Banks saved at the last moment by rushed alliances. Businesses propped up by emergency credit from private financiers. Each incident demonstrated the fragility of a system reliant on improvisation. People began to ask why the nation depended on hurried rescues instead of structured protections. The question lingered through markets and main streets, adding urgency to the unfolding conflict. Pressure mounted further when a series of regional disturbances exposed the limits of interbank cooperation. Institutions that had once supported one another now found themselves stretched too thin to offer meaningful assistance. The illusion of stability cracked, revealing a landscape where survival depended more on luck than on design. Behind closed doors, even the staunchest opponents of reform began to admit that the era of resistance was ending. The push for a unified reserve had entered a new phase. What began as a quiet suggestion had grown into a national debate, charged, unavoidable, and inching toward a decisive break. The system could no longer continue as it was, and the forces gathering in this moment would soon collide in a struggle that determined not only how American finance would function, but who would hold the power to shape its future. The conflict over a unified reserve reached its peak as the nation confronted the limits of its fractured financial system. What had once been a debate among experts now spilled into every corner of public life. Merchants blamed sudden credit shortages for declining sales. Farmers protested interest spikes that arrived without warning. Industrial leaders warned that unpredictable financial conditions threatened the country's competitive edge. The frustration that had simmered for years finally surged into collective demand. Something had to change. Inside Congress, tensions sharpened into open confrontation. Reformers presented data showing how previous panics might have been softened or prevented entirely by a central reserve capable of supplying liquidity when markets grew strained. Opponents fired back with equal passion, arguing that centralized authority posed a greater threat than financial instability itself. They feared a distant institution able to dictate interest rates, currency flows, and banking practices. Fears rooted in deep historical distrust of concentrated power. As argument intensified, the economy provided a stark backdrop. A series of bank failures in isolated regions sent shockwaves through connected markets. Commodity prices swung unpredictably. Businesses delayed expansions, citing fears of another panic. Each new disruption reinforced the central truth reformers had been shouting for years. The system was not only fragile, it was fundamentally mismatched to the complexities of a modern nation. Behind the scenes, influential financiers gathered to study proposals and weigh their implications. Some viewed a unified reserve as essential to preventing catastrophic spirals. Others worried it would limit their autonomy. The meetings grew heated as personal interests collided with national concerns. Yet even the staunchest skeptics understood that relying on improvised rescues and private coordination was no longer sustainable. The system had outgrown the tools designed to protect it. Public anxiety fueled the transformation. Newspapers published vivid accounts of banks scrambling for liquidity. Editorials questioned how a nation of growing global influence could lack a coherent strategy for managing its own financial cycles. Citizens followed the debate closely, sensing that the outcome would shape not only markets but the rhythms of their daily lives. Stability was no longer an abstract concept. It had become a necessity. Political leaders faced mounting pressure to act. Attempts to craft a compromise revealed just how divided the country remained. Should the unified reserve be government-controlled or privately managed? Should it hold absolute authority or operate in partnership with existing banks? Each question exposed deeper ideological divides. Yet behind every disagreement lay the same realization. The old system was collapsing, and no amount of sentiment could preserve it. The conflict reached a decisive moment when a minor disturbance, barely a tremor compared to previous panics, triggered outsized effects in multiple regions. Banks tightened credit overnight. Merchants panicked. Investors rushed to shift assets. It became clear that even small shocks could now produce cascading consequences. The system was too interconnected, too sensitive, too vulnerable to continue as it was. With this final warning, the push for reform transformed from debate to necessity. The nation stood at the edge of a moment that would alter its financial future forever. The next step, whether bold or cautious, would determine whether America embraced stability through unity or continue to gamble its future on a structure built to survive a very different era. The turning point arrived when policymakers, financiers, and exhausted citizens realized the country could no longer endure another cycle of panic. A minor shock, hardly noticeable in earlier decades, had triggered a chain reaction that rippled across states, markets, and industries. It was a final confirmation that the system had outgrown its safeguards. The debate was over. The nation needed a central reserve, not as an experiment, but as a lifeline. In urgent meetings that stretched late into the night, proposals long dismissed as radical were reconsidered with new clarity. Lawmakers who had once opposed centralization now acknowledged its necessity. Bankers who had feared loss of autonomy recognized that autonomy meant little in a collapsing system. The discussions were tense, charged with decades of ideological conflict, but beneath the disagreements lay a shared understanding. Without a unifying force to stabilize credit and manage liquidity, the next panic would be catastrophic. The framework began to take shape piece by piece. A reserve network, structured, coordinated, and designed to supply liquidity during moments of strain. A governing board, capable of responding faster than scattered institutions acting alone. A unified strategy, replacing improvisation with informed, deliberate action. For the first time, the system would have a mechanism not just to absorb shocks, but to prevent them from spiraling into national crises. Yet the transformation was not a triumph of vision alone. It was forged from urgency, compromise, and the raw memory of failure. Many feared the consequences of centralization, but they feared the cost of inaction more. Communities scarred by past collapses demanded protection. Businesses insisted on stability. And citizens, tired of watching their futures dissolve in moments of panic, demanded a system worthy of their trust. When the final decision came, it marked more than a policy shift. It signaled a new chapter in American finance, a recognition that strength required cooperation, that stability required structure, and that a nation as vast as the United States could not rely on fragmented tools to manage an interconnected economy. The unified reserve was born not simply from ambition, but from the lessons etched into the country by decades of turmoil. In the years that followed, the system evolved, expanded, and adapted. It faced new challenges and new crises, but it brought with a foundation capable of anchoring the country when uncertainty surged. And though its creation was contentious, its impact reshaped the financial identity of the nation. The battle for a unified reserve revealed a truth still relevant today. Progress emerges when a nation is willing to confront its own weaknesses, and stability is built not in moments of ease, but in the aftermath of hard-earned understanding. Subscribe to join the journey.